It's March 2026, and the entire global economy is on a knife's edge. And it all comes down to one single number that has sent a jolt through every market on the planet. Let's get right into it.
Here it is. This is the number that has everyone's attention. A $20 per barrel spike in benchmark crude oil. And look, this isn't some slow, steady climb. This is a massive price shock, and it's happened in just a few short weeks since hostilities kicked off on February 28th. So you have to ask, what on earth could trigger a move this big, this fast?
Well, here's your answer. We're seeing a near-total shutdown of shipping through the Strait of Hormuz. A military conflict in the Middle East is basically just slammed the door shut on one of the most critical arteries of the global economy.
And just to be absolutely clear on the scale of this, the International Energy Agency is calling this, and I quote, the largest supply disruption in the history of the global oil market. When the IEA puts out a statement that stark, you know we're in uncharted territory.
So let's start there. Let's trace that initial shockwave. What does it actually mean on the ground when this choke point closes?
The volume is just breathtaking. We are talking about nearly 20 million barrels per day of crude oil and other products that are now completely blocked. To put that in perspective for you, that's roughly one-third of all oil traded by sea gone. Just like that.
And in this data here, it shows you exactly how this shutdown is playing out. Look at this. Daily tanker transits have plunged from around 100 a day to maybe 5 if they're lucky. That leaves about 350 massive oil tankers just sitting there, idle. And the cost to even try to make the trip? War risk insurance has exploded, making it pretty much impossible to do business.
For the Gulf states themselves, the impact is frankly catastrophic. It's way more than just lost oil money. Qatar Energy has declared force majeure, which is basically a legal way of saying an unforeseeable event is preventing them from delivering on their contracts. The entire regional aviation industry is grounded, and since they import most of their food through the strait, they're facing what's being called a grocery supply emergency.
Okay, so that's the immediate shock. Now let's follow the ripple as it spreads out and turns this regional crisis into a full-blown global problem.
The International Monetary Fund, the IMF, they've put it about as bluntly as you can. They say all roads now lead to higher prices and slower growth. Everywhere. No country is going to be able to dodge this. The surge in energy and food costs is going to hit every single one of us.
And this brings up a word that we haven't had to seriously worry about since the 1970s, stagflation. The data is pointing towards a very real risk of this exact scenario. You get stubbornly high prices, but at the same time, the economy just stalls out. And for a central bank, that is the absolute worst-case scenario.
And you know, this crisis goes way beyond just the price at the pump. The data shows that about a third of the world's fertilizer trade goes right through Hormuz. That disruption has a direct line to your grocery bill. We're now seeing projections of a 15 to 20% jump in food prices by the next quarter.
So, with inflation suddenly roaring back to life, how are the big central banks going to react? All eyes, of course, are on the U.S. Federal Reserve.
And what a pivot we're seeing. It's really dramatic. Just a few months back, in December of 2025, the Fed was forecasting inflation at 2.4% and talking about multiple interest rate cuts. Fast forward to today's March projections. They've bumped their inflation forecast up, and now they're signaling maybe one single rate cut for the rest of the year.
This is what's called the Fed's dot plot. Think of each dot as an anonymous forecast from a Fed official on where rates should be. And you can just see it visually. The whole cluster of dots for 2026 has shifted higher. This is the Fed's way of telling the markets, get ready for interest rates to stay higher for longer.
So let's just boil down what we learned from that March meeting. The Fed is holding its key interest rate steady. Their preferred inflation number, PCE, is now seen ending the year higher at 2.7%. The bottom line, the Fed is taking a very hawkish stance. They're choosing to fight this new wave of inflation head-on.
And, you know, it's important to mention here that the investment information, comments, and recommendations contained herein are not within the scope of investment advisory. We're focused purely on breaking down the macroeconomic data.
All right, so in a world with spiking inflation and major geopolitical risk, where does capital flow to find some safety? Well, the data is pointing in one clear direction: precious metals.
This is a classic market reaction, a textbook flight to safety. When there's this much uncertainty in the air, investors tend to flock to assets like gold and silver, things that have historically held their value when inflation is eating away at paper currencies.
And just look at the scale of this forecast change from JPMorgan for silver. The old forecast from just a few months ago is on the bottom, and it's just completely dwarfed by the new projections. This really reflects silver's unique position. It's not just a safe haven metal, it's also a critical industrial metal for things like solar panels and EVs.
And here's the headline number. JPMorgan is now calling for an average silver price of $81 an ounce in 2026. That is more than double its average price in 2025. It signals a potential complete reevaluation of the metal.
So when you put all of these pieces together, what's the big picture? What's the strategic outlook for this new reality we find ourselves in?
The World Economic Forum actually has a name for this. They call it Geoeconomic Confrontation, and they've ranked it as the #1 global risk for 2026. It seems we've moved into a new era, a fragmented equilibrium, where the goal isn't just about making supply chains cheap and efficient anymore. Now, it's all about making them secure and resilient.
To help you keep making sense of our increasingly fragmented world with more data-driven insights like this one, please make sure you subscribe and turn on notifications. And if you found this breakdown valuable, hitting that like button and sharing it really helps others stay informed too.
So we'll leave you with this final thought. In this new era of higher inflation, higher interest rates, and fractured supply chains, what is the true price of resilience? Because the answer to that question is going to define the economic story for years to come.